It's Ira Jersey now from Credit Suisse. Ira, I'm not going to ask you about European policy. I think you're going to go, no, Tom, I'm not going to do that. Let's talk bonds. Talk about resiliency, which is a call against consensus. Why have we once again gone to lower interest rates if everybody's looking for level to higher yields?
Yeah, well, I think a lot of people had been looking for higher yields on the idea that quantitative easing ending would leave a big gap in demand for treasuries, but we haven't seen that. We've always thought that we'd be going through a little cyclical soft patch here, and today's data didn't really say that we were going through a soft patch, but a lot of the other survey data and the like have showed that we're kind of the second derivative, so the trends are kind of slowing a little bit. So treasuries rallied, and I think today's strength is kind of interesting given this, the strong payroll data. Treasuries are off, but they're well off their lows as well.
Jargon alert, Ira Jersey, did he get the memo? It's math-free May. It's math-free May. He's second derivative. I'm associating that, Ira, with acceleration or deceleration. Do I have that right?
That's absolutely correct. So one of the things is, if you look at some of the survey data, for example, the ISM services data this week, it was significantly weaker than it was, but still on an uptrend. But it's still above 50, so that's still saying that the service sector is growing. It's just not growing at the pace that it was the month before, and that helped spark a rally that got us down to new near-term lows in yields, and that accelerated yesterday with the significant sell-off in equities and commodities.
Let's bring up a chart here. 2's10 spread. We're all spreads with Ira Jersey. Waiting for a restrictive Fed, and this is a difference in yield between the 10-year and the 2-year, and you can see how sustained, how wide that spread has been up here at about 260 basis points. Ira, what is the curve going to do in the coming months? Let's take this 2's10 spread. What are we going to do here in the next 6 months?
Well, we've been saying for a long time that that particular curve could stay persistently steep, at least until such time as the Federal Reserve starts to be in play. So as long as we continue to get a slightly better economy, if we continue to have job numbers like we had today, then by year end we're going to start pricing in for a Fed that's going to be active in 2012. As that happens, you're going to see that spread significantly flatten. That being said, some of the markets, for example, the forward markets on interest rates, are already expressing the fact that we should have a significantly flatter curve, and in particular in the 2-year sector. So the forward, as of a couple of minutes ago when I looked, was saying that the 2-year was going to be at about 135 basis points about a year from now, and which is almost double where it is today.
Right.
So you're already pricing in for that in some markets. You're pricing in for a Fed that's going to be active at some point in the future.
Right. Nicely explained. Folks, look at this with their hands. Here's a 10-year yield, and here's a 2-year yield lower. And that difference in yield is that 2's10 spread. There's many spreads that the pros look at. Ira, why is the 530 spread so important when we look at QE2? Here's the chart, folks. The 530s, difference in yield between the 30-year bond and the 5-year note. Why does that spread matter?
Well, one thing that spread, I think, is telling you anyway is that there really has been some strength in the long end, but really the 5-year sector has done very well on the curve. And in fact, up until a couple of days ago, that had been one of our favorite recommendations, was owning the 5-year on the curve. We did get out of that trade just because we were worried that valuations in the Treasury market were getting a little bit extended. We had broken out of the range we'd been in, and we do think ultimately we'll be back in that range, but the 5-year sector in particular, it tends to be market directional. So if you don't like the market, you're selling the 5-year. If you like the market, you're buying the 5-year.
Let's talk bonds with a guy who thinks we could go under 3%. Earlier this morning on Bloomberg Surveillance, 7 to 10, Bloomberg Radio, I spoke with David Rosenberg of Bluskin Sheff, and I asked him, what is the bond market telling us about his American economy?
The fact of the matter is that the bond is the enemy, and nobody wants to see bond yields going down because it doesn't fit in with the very rosy economic scenario that comes out of most Wall Street research houses. But the reality is that the bond market, even as the stock market was making its peak last week, the bond market was telling you all along that things are starting to cool off.
David Rosenberg, the bond is the enemy. Ira, you're the enemy here. I mean, it's an interesting time. Have you ever seen the scrutiny of the 10-year like we've got today?
Yeah, not recently. You know, I think one of the things that the market's telling you, and this goes back to my looking at the forward. So these markets that are pricing in for where yields are going to be next year, it is telling you actually that yields are going to be higher, but yields today, so in the near term, are not. And I think that is the idea, and posing the idea that the economy is going to be weak, that over the next couple of months, that the Federal Reserve is not going to be active this year, but at some point in the future they will be. And as we accelerate, this is something that our global strategy team of Jonathan Wilmot and James Sweeney talk about quite a lot, is a snowball effect. So the service economy starting to grow. You look at today's payroll numbers, the service economy,
right.
Service jobs grew quite nicely. As that continues, and as we pick up momentum in the economy, the market will start to sell off. But not in the long end. It will wind up being the front end. The long end is likely to kind of hover in the ranges that you've seen, and it's really the front end that winds up selling off very hard.
Well, where's the 2-year in a year?
A year from now, we have about 1%, and that's just we do think, though, in the interim, it could go a little bit higher than that as people push forward, move forward Fed expectations that we think won't ultimately be realized. So you're still looking at higher yields.
Great summary. Have a great weekend. Ira Jersey, Credit Suisse.